thank you everyone for joining us today. My name is Anna Sarin. I'm Director of Listings Development with the Canadian Securities Exchange. Thank you to Cambridge House and VRIC for putting on what is already started off to be a very successful event. Very much love working with them. I'm joined today by two of my favorite capital markets people, Richard Carleton, CEO of the Canadian Securities Exchange, and our friend Jason Peltrowitz, who's Director of OTC Markets Group and EVP of Corporate Services. Welcome, gents.
Thank you, Anna.
We're going to have a conversation today that we were laughing about earlier. We've had this conversation over and over and over again for years, but it's one that needs to happen because there's an incredible opportunity for Canadian companies to access capital beyond our borders. So we're going to talk about how we do that, how we access it, and the opportunity that lies there. So why don't we just start? I'm going to start by having you guys introduce yourself a little bit. For those that don't know the CSE or OTC, you can just give maybe a quick elevator pitch of both.
I'll go first. Thank you guys for joining and thank you for having me. I know he pays you, so he's one of your favorite.
That's true.
I don't, so
That's
I feel
true.
very honored.
True story.
So Jason Peltrowitz, OTC Markets Group. For those of you who don't know, OTC Markets Group, we are actually the largest stock market in the U.S. for non-U.S. equities. We are home to thousands of equity securities from around the world, all of which are looking to access U.S. capital, whether that be in the form of private placement or just secondary market trading. We are the home to over 1,000 Canadian, predominantly mining and resource companies on our OTC QX and QB markets, listed there mainly to allow U.S. investors to be able to buy those securities, but also for what we're doing here today is to be able to raise capital in the U.S. In a cost-effective and efficient manner.
Thank you very much, Jason. And I'm Richard Carleton, the CEO of the Canadian Securities Exchange, a role that I've held since July of 2011. The Canadian Securities Exchange, for those of you who may not know, is the 20-year-old overnight success story in Canada's capital markets. During this business cycle, the CSE has been responsible for listing the vast majority of the new mining companies that have come into the capital markets in Canada over the last 3 years. And we've seen a shift, as you all know, from predominantly precious metals exploration to moving into the battery metals in particular. So lithium, graphite, zinc, cobalt, nickel, copper in particular. And we have seen probably 200 companies, I think in the last 3 years, from the mining space have joined the Canadian Securities Exchange. And we're here with Jason today because we've worked extremely well over the last 10, 15 years in helping Canadian companies, Canadian reporting issuers, access private placement capital in the United States. So that's prospectus exempt capital without having to become a reporting issuer in the US, without having to register with the SEC, without having to pay the officers and directors insurance premiums for being a public company in the United States. The benefit of a Canadian listing, you are able to raise substantial amounts of capital from US investors. And then once those deals have closed, you're able to offer a liquid and accessible market in the United States for institutional investors, retail investors, and so on, priced in US dollars, that is kept very tight with the Canadian market because of the activities of the cross-border arbitrage traders. So of course, what happens is if the home market price on the Canadian Securities Exchange, or maybe even other exchanges in Canada that I won't mention at the moment. But if there's any kind of deviation from the home market price, the arb traders instantly bring that US market back. So all of the things you may have heard, the spreads are too wide, the markets are... No, that's not the case. We have very liquid markets between Canada and the US for these names. But then when we looked at the lists, we noticed that the last generation of mining companies that have joined the exchange aren't necessarily taking advantage of these opportunities at the same level, which is really on us. You know, we need to get back in, engage with the mining community, and educate them around what it takes to access that US investment capital. By the way, the US is still 55% of the global equity market. So that it is the largest pool of investment capital available, and an obvious place where Canadian miners who are active in whether it's call it the carbon transition or whatever, That's the theme of the United States too. That is going to engage with significant parts of the US investment community. Jason, why don't you talk a little bit about how you do that, what the process is for a Canadian company to...
Yeah, thanks, Richard, and great introduction. So a lot of people don't recognize or understand that if you're a foreign private, what we call a foreign private issuer, so if you're listed on the CSE or the other guys across the hall, you do have the ability to have an OTC market listing in the US utilizing your Canadian disclosure. And it's relatively easy and cost effective. Most US investors do not have access north of the border. And if they do, it's incredibly expensive. There's FX. And so by utilizing your CSE disclosure for relatively little effort and providing that disclosure to us on a timely basis, you can have a security that trades in the US during US and Canadian trading hours in US dollars that is compliant with all federal and state securities laws and allows US investors access to that Canadian security. Now, our QX and QB market are also what are called SEC established public markets. And for the purposes of equity financing, it means that the price in dollars on our market is the price you can use for equity financings. So last year on OTC QX and QB securities, over $1 billion was raised, not on the exchange. And so for companies that think, well, if I go to the US, I have to list on the New York Stock Exchange and NASDAQ, I have to be Sarbanes-Oxley compliant, I have to be SEC reporting. The fact is, if you're listed in Canada on the CSE, you can avoid all of that, but still gain access to the same investor base and the same ability to raise non-prospectus capital.
It really is one of the great capital markets bargains in the world. So for the cost of the listing in Canada and a modest fee in the United States, as I say, you're able to access the largest pool of investment capital in the world.
I would say that a lot of our clients are junior miners, Canadian miners, TSX, CSE, but the model works across the board. And so our biggest clients are companies like Roche, Adidas, Heineken, Air Canada, large mega cap companies, again, that also don't want to pay for the cost and complexity of a US SEC reporting exchange listing. So it's the same structure that allows that to happen. And it's the SEC's recognition that if you're on an established exchange outside of the US, CSE, TMX, Deutsche Börse, London Stock Exchange, the quality and level of disclosure is just as good, if not better, than the US. So why should the regulators require you to be duplicative in that reporting and spend all of the extra money and have all of that extra infrastructure? So it really is a recognition by the US regulator that the things that you're providing to the CSE are just as good, if not better, than probably what you'd be providing to the SEC. So you should be able to have the ability to have that public market and be traded while still being in compliance with all of the rules in the US.
Hey, Jason, speaking of rules and requirements, why don't you tell us a little bit about DTC eligibility and why it's...
You're the big DTC preacher man.
Yeah, because that way I get to use my favorite word in the English language, fungible. That is actually the secret sauce, is that the shares that trade in Canada are the same as trade in the United States. There's no requirement to have, what do you call those fancy
separate
things?
Class of share or an ADR, or anything. It's
yes.
the same share.
Same share. So it cuts down, again, on the friction costs, which, again, translates into a very tight market as between Canada and the United States. And it's really only the currency conversion that presents any kind of challenges for the market maker. Now, I think shift gears slightly. One of the other issues that often comes up when we're talking about the current trading market, in particular for junior miners and other companies in the small cap space, is really the whole issues around short selling. Now, I'm taking this one on, taking the high road, or at least taking it on straightforward, because I know that this is an issue that comes up every time it seems I come to Vancouver. People are asking me about the market structure. Why doesn't the Canadian Securities Exchange ban short selling? Why don't we reinstitute the tick test, meaning you can only short on the uptick? All sorts of things. And people are genuinely concerned, whether it's the companies or investors, in terms of how the price discovery process is working on the secondary markets in Canada. And I think it's fair to say that this is something that we have been acting on behalf of really the industry the investors, the companies that are trying to raise capital, that are trying to enhance the valuation for their shares in the face of what they believe are abusive short selling tactics that have been carried on in the markets over years. And so I think it's fair to say that, well, the first thing is that, one, it's not the exchanges who actually set the rules for short selling in Canada. It's not us. It's not the guys on the other side of the building. It's actually the market regulator, CIRO, C-I-R-O, the Canadian Investment Regulatory Organization. And they've recently issued a comment paper on changes to the trading rules that aren't major changes to how the short selling is to be monitored and regulated. It is effectively a restatement of what the rules are right now. And the bottom line is, if you are consistently failing to deliver the shares that you sold short on T+2 and soon to be T+1, so we're moving to a next day trade settlement system at the end of May this year, and if you are consistently failing to deliver those shares, that's going to be a violation of the trading rules and subject the dealers and potentially the clients to sanctions from the industry regulator. I think it's fair to say that the regulators are now conversant with and understand the tactics that have been used, and we can actually address those with that rule. And given that we were talking about fungibility in clearinghouses before, there's also a process that if somebody fails to deliver shares, there's what's called a buy-in. And that is where the clearinghouse says, so-and-so failed well, not so-and-so. We need X number of shares in XYZ Inc. in order to complete this trade. And what happens is they offer it up for sale at 15% premium to the market. That normally unlocks those shares from the market, and then the buyer of those shares receives them, and then the 15% premium is charged against the dealer who failed to deliver the shares.
So you're going to do what we've been doing in the States all along?
Yes,
Nice.
we are.
Canada's coming along for the ride.
Making the buy-ins mandatory at the clearinghouse, and I understand this is deep inside baseball, but this is how we have to attack this problem. Making the buy-in mandatory is going to, I think, make an enormous step forward towards controlling abusive short selling. Short selling on its own is great. It contributes to liquidity. It's also part of the price discovery mechanism. If you look at back in the global financial crisis when the Canadian banks were part of a short sale ban in the United States because they were interlisted in the United States, National Bank wasn't because they're not interlisted. Their liquidity was not impaired in any way, shape, or form. Turnover of the Canadian bank shares was down 40, 50%. So we had a perfect indication of how devastating an impact on short-sighted measures to control abusive short selling can be. So again, short selling is an important part of the price discovery process, but there really is no room for abusive short selling practices that I'm afraid are probably too accepted in this marketplace.
Thank you, Richard.
Thus endeth the rant. It is Sunday after all.
I was going to let you talk about short selling when we had 1 minute left so that we could sneak you off the stage. But I do want to get back to one thing with Jason while we have him up here. You talk about exempt capital that we can raise. Jason, do you want to touch on some of the exempt opportunities across the border? Reg A Plus has obviously done quite well over the past few years.
Yeah, well, in addition to Reg A Plus, obviously there's Reg D. There's any number of different types of private placements. Ultimately, it can take the form of, a pipe transaction, Reg D, Reg A. You can even do Reg CS, although I don't know that that's considered private per se. But any number of forms of capital that you can raise. And like I said, last year on OTC, QX and QB, 1.3 billion was raised in any number of those different transactions. Now, each of those are different. So Reg A, as an example, those shares become immediately freely tradable. So unlike Reg D, where there's a 1-year lockup or a 6-month lockup, depending, where those shares are not immediately tradable, any Reg A you raise is immediately available to be traded on a secondary market and can be raised from retail. Whereas when you're looking at a Reg D transaction or others, you're probably looking at institutional or family office accredited investor with a lockup before those shares become freely tradable. So ultimately, the message is there's any number of ways to raise capital in the U.S., but the common denominator is whether they're freely tradable on day one or freely tradable on year plus one. Without a U.S. public market to be able to trade those securities, it becomes difficult to raise money from those investors.
Yeah, and I will reiterate, given the size of the U.S. capital pool, there is an appetite for companies which are, again, following the electrification of the economy theme.
Yeah.
Investors there understand. So there should be an opportunity for the Canadian mining companies that are struggling to raise capital. This is just another arrow in the quiver, I guess, to another tool in the kit, whatever you want to call it, in order to help meet the funding needs for these companies.
And when we cross the border, Jason, what's important as an issuer crosses the border to raise capital? What is important for the issuer to take into account? What do they need to address when they're crossing the border? Just getting your OTC ticker is probably not substantial to be able to enter that marketplace.
Yeah, so we always put it in terms of tradability and visibility, right? So getting the ticker, that's the tradability. You want to give investors access to be able to see your security in US dollars wherever it is they do their investment research, whether that's Bloomberg or Yahoo or anywhere. You want to have that US ticker symbol. But then there's the visibility, right? That's the investor relation. That's what there's thousands of vendors here that are going to tell you, how you get your story out. And that's important as well. It's not enough just to put out a press release every once in a while and do your financial results. You need to be accessing the U.S., whether it's hitting up the big, shows like this that we have all over the U.S., making sure that your press releases are crossing the border and getting out into the U.S. market, making sure that you're telling your story on your website and our website so that investors can see if you're doing an investor presentation, if you have research reports. It really does become about making sure that you're globalizing your investor relations strategy, but doing it in a way that meets your needs. So doing it kind of online in an information age so that it's cost effective, but it is what we call lighting up the screens in the US on an ongoing and regular basis.
I think the one thing that we're starting to see in this relationship has been a legacy relationship, but really as an issuer now coming to market, they are going outside of their own borders to raise capital, and that's becoming more and more, I think wherever you're listed, that's becoming more bigger part of practice. So taking advantage of something this easy makes a lot of sense, especially for Canadian issuers. Richard, is there anything that you want to touch on just as far as Canadian markets and why crossing the border might be of value?
Not shorting.
Yeah, I've only got 1 minute left. Well, one of the other things, too, is the U.S. OTC actually has a bigger footprint than most Canadian exchanges do internationally. And so when we talk to investors in South Asia, in Europe, in parts of Africa, the Middle East, they often have access to Jason's market. They may not have access to Canadian Securities Exchange or the guys at the other end of the hall. And so understanding that you have two symbols. You have your Canadian symbol, 3 characters, 4 characters, whatever. You've got your US symbol, 5 characters ending the letter F. You need to understand that you need to tell people internationally about that 5-character US symbol, because in many cases, an investor in Germany, Austria, Switzerland, in Israel, in wherever, will be able to access that name via the US OTC.
On that note, we do have to wrap up, but lucky for any of you that are interested in talking with Richard or Jason Moore, our booths are side by side just at the other end of the hall. So feel free to come by and chat with us further if you guys have any questions. Thank you.
Thank you.